I take your point. I will come to the capex part and the stimulus that it may provide in just a bit. Soumya, let me get initial comments from the other guests as well. Mridul, Saggar, your contribution to Moneycontrol, your excellent piece. Mridul, you can hear me? Okay, I think we'll get to Mridul in just a minute. Let me get the banking perspective. Neeraj Gambhir is with us. Neeraj, Soumya ended his analysis by saying that the borrowing number is below what the market was expecting. Market would have been prepared even for 15.8 perhaps, maybe even 16, but 15.43 trillion rupees to be borrowed is something the market can take with both hands. You agree?
Yeah, I tend to agree that the borrowing number is in line, broadly in line with the market, not below, I would say. But in line is also a bit of a relief because the worry was that this being a full budget ahead of the election, there could be tendency to sort of spend a little bit and maybe compromise on the fiscal deficit. But the fact that the finance minister has continued with the glide path on fiscal deficit, stuck to 5.9, reiterated the fact that we will get down to 4.5 by 24-25. I think these are all assurances being given to the market that the borrowings will be well controlled and the fiscal deficit numbers will be maintained. And coupled with the fact that states have borrowed less last year and we need to still see what state numbers are going to look like for this year, I think there is a bit of a relief rally in the market to say that it is not all that bad.
Okay, Neeraj, let me just play the devil's advocate. Last year, or I should be saying this year, the states did not borrow as much as you correctly pointed out, and that gave more elbow room for you bankers to gobble up on central government bonds. Now, it's quite possible that in the coming year, the states will exhaust their full borrowing. Last year, for a better part, they have been maimed by the Omicron backlash as well. It's possible that there is more elbow room now and more bandwidth to go in for capex. If the states were to borrow their full length, and now they've been given a 3.5% fiscal deficit room, and if insurance doesn't come in, that's the big one. There are a lot of negatives for insurance companies. Premium over 5 lakh will not get tax benefits. So, it's quite possible that the guaranteed products, which led to a lot of buying of bonds, may not be that sumptuous this time. Do you see a problem?
Well, there are obviously a number of assumptions and there are a number of variables at play. The two of them you counted. I can count one more negative, which is basically that if the small savings increase that the government has budgeted for next year, if that doesn't play out, then also we will have a challenge. On the flip side, I think that is, and this is something that will play out through the rest of the year, is that if liquidity in the system continues to remain so tight, and there is a need for Reserve Bank to then do OMOs to support the liquidity in the system, right? That is something that we need to be also mindful of. There is obviously this whole question of at what point in time we will see FPI's return to the domestic bond market and whether there is going to be an index inclusion. So I think there is a bit of a variability at play here. We need to take one variable at a time. I think the main important variable for today's conversation was whether the fiscal deficit number and the intended central borrowing number is in line with what the market is asking for. And I think it was indeed the case, which is why there is a sigh of relief.
Okay. Well, actually, I was preparing for this discussion with Soumya, and he was also pointing out about the small savings expectation that they can take, 4.8, is it 4.8 trillion rupees from the small savings. Soumya, would you agree that is difficult? See, the thing to say on behalf of the government is that there is this Mahila Samman Bachat Patra, which is a 2-year period with a deposit facility of up to 2 lakh for women. I intend to take benefit of that. And then there is also a senior citizens enhancement of maximum deposit limit. Won't all this help the government in getting more money from small savings? Soumya?
There are two parts to this discussion. The first part is the assumption in the current year. If you actually look into the numbers of the small saving collections till November, the government had budgeted, I think, around 4.2 trillion. I think around less than 50% of that has been achieved till November. But the target has been actually hiked to 4.3 trillion for this year. So I think there could be some, struggle in achieving that numbers. For next year, The 4.7 trillion numbers, however, is achievable because I think that will come on the back of that scheme for the women which the government has announced. So my overall sense is that given the fact that government has the small saving collection numbers have actually been revised significantly upwards, even as the collection till November are less than 50% of the earlier budgeted estimates, my sense is that the tax numbers could see a further revision upwards given the traction. So whatever you are saying seeing in the budget in terms of the revised numbers, that could see a further upgradation when the final numbers are announced.
Why do you say that? Actually, I was looking at the tax collections in November and December.
Yes.
Both these months, the tax revenue is lower than what it was in the November and December of 21. So why are you assuming that the revised estimates could be revised further up?
See, I'm not assuming that. This is basically based on the small saving number collections.
Okay.
If the saving collection is significantly lower than 50% today and that has been increased in the current budget, that means there has to be, this gap has to be fulfilled from somewhere. So if the market is able to give out this number in the next 3 months from January to March, it's fine.
Fair enough.
Otherwise, the tax numbers could come as handy as has been anticipated in the budget today.
Fair enough. No, but I'm just asking you whether next year this getting from small savings 4.8 trillion, as Neeraj says, could be a tall ask.
No, I agree with Neeraj because that this year it has been a tall ask. Next year also the numbers are almost similar if you look into the revised numbers and next year's numbers. So it is going to be of course a tall ask, but my belief is that the scheme which has been announced by the government, that could actually act as a cushion. But I agree with Neeraj that this is going to be a tall ask next year also, because if you are moving to a new tax regime and that will actually further, and with no changes in the capital gains, I think that will further incentivize the households to continue moving to the financial markets. So my sense is that yes, that will be a challenge.
Okay. Just that one more addition, Neeraj, and then I'll go to the other aspects of CapEx. Do you think insurance will not deliver this time? I think they gave you all 2 lakh crore of bonds, right? Bankers were warehousing some 2 lakh crore of bonds this year for insurance companies. You think that may not come next year?
Yeah, there is some downside to that number. I think one of the reasons was that last year, now after doing 2 lakh crores and whatever that number is that you talked about, all banks are in terms of limits, they are kind of full, right? So there is less incremental demand. There is also this issue of accounting between the cash and the derivatives, which impacts the bank balance sheet. So it limits the ability of the bankers to, warehouse these kind of transactions and then give it to insurance as a derivative product. So there are some of these technical issues that are at play, which make me believe that potentially this year you could have a lesser number on account of bond FRAs to support the borrowing program.
Okay.
But the fact of the matter is that fundamentally insurance is in a very secular uptrend, right? So it's not just about the tax. So there is a sustained upside, not just from insurance, but also provident funds.
I take your point. The market is telling you that message which you are telling me now. Today, the bond yields have closed at 7.27. When we started the day before the budget, it was 7.39. So, the market is loud and clear saying that, this is the borrowing program, we can handle it with our left hand. That's what the bond market seems to be saying. I was expecting even Mridul, Saggar to join, but we're having some connectivity issues. But we have another economist joining us, Aditi Nair, the chief economist at ICRA. Aditi, all the budget assumptions have got a big green tick from Neeraj and Soumya over here. They believe the growth assumptions, the tax growth assumptions, and the deficit assumptions are exactly what the doctor ordered. Would you agree?
Thanks, Latha. Well, certainly, I'll tell you where we are very positively surprised today is seeing a capex number which is much higher than what we had expected. And therefore, the fiscal deficit number for FY22 is also a little bit higher than what we were penciling in, as is the gross borrowing number. But given the fact that the increase is coming on account of capex, we're happy to see that. On the tax side and on the nominal GDP side, our nominal GDP growth assumption is 10% for FY24. And we think there's a little bit of overhang from the excise side, which will continue for the first 2 months. So, the base effect of the excise cut will continue for a couple of months. So we had actually expected the gross tax revenue growth number to be a little lower than what the government has penciled in. So just a minor sort of quibble on that front. I agree with you. Yesterday, the December tax numbers were below what we were expecting. So we kind of, the revised estimates we think are appropriate. But I totally agree with you that the December tax numbers underwhelmed to some extent.
Okay.
And that leads us to believe that there is a little bit of optimism in the gross tax revenue number for FY24. We would also...
I just want to add one point over there, Aditi. The finance minister herself said that the giveaways because of the extra, raising of the limit on the personal income tax is going to lead to a 35,000 crore of revenue loss. Now, if you take that as well, then I'm wondering if, there's just a wee bit of overestimation on tax revenues. We could be pleasantly mistaken, but even if it is an overestimation, it's extremely minor, so perhaps can be overlooked. But I want to flag off what you just started off, CapEx. And that's the big point of this budget, the flagship slogan of this budget. Soumya, do you think it has enough spunk, enough force in it to push the growth? Do you think this can spur private capex?
No, I think, Latha, the capex numbers are very aggressive, but just a small point of caution. Yes, the overall numbers, as I said to you in the beginning, if you look into the budget estimates, the creation of capital asset, the CPSE, the number comes at 18 trillion. There was some downward revision in the FY23 revised estimates. I think around 1 trillion crore less capital expenditure in the revised estimates. So we have to look at that perspective. But having said that, I think even if we are able to do 90% of what has been achieved, what is projected in the budget, I think that itself will be a very good growth multiplier. Because I think all of us were expecting that, given the fact that private investment is still continuing to show just nascent signs of recovery, it will be worthwhile to push capital expenditure for the crowding in impact. And I think exactly that has been done in the budget. So my sense is that it will be growth positive, and actually it will be growth accretive. And one final point regarding the nominal GDP, I think, as we have discussed earlier also, I think given the fact that global economy is poised for a soft landing, lower commodity price cycle and maybe a lower crude prices could actually be growth accretive. So from that point of view also, I think we could see some surprises on the real GDP numbers. But as a whole, 10.5% is an reasonably fair assumption on the nominal GDP growth rate.
Fair point. Let me get the capex part, and now pleasantly we have got Mridul Saggar on the line. We had a problem connecting with him. Very important voice. He has made policy, was member of the Monetary Policy Committee until recently. Mridul Saggar, you had very strongly asked for a fiscal deficit even below 5.9%. I think even below 5.8 when you wrote for Moneycontrol before the budget. It's come in at 5.9. Is that a disappointment? And more importantly, capex. Do you think that is a very big stimulus for the economy? So two questions.
I think, so let me start with the capex first. I mean, there's absolutely no doubt that this is a big stimulus in the sense that, it's a 33% rise budget estimate to the budget estimate, and actually 37% rise if you see in the revised estimates. So this is unprecedented. And now the capex numbers have actually, one is the capital expenditure, but if you see capital outlay out of it, the capital outlays are at a record high. And I think we have to, and all of us should need to give credit to the government on this front.
Okay.
I think the declining trend in capex will be decidedly reversed in the last 3 years.
Got that. Let me ask Neeraj. Neeraj, is the private sector biting? Is the private sector on the verge of a capex outburst?
We've certainly seen an improvement from where we were. There is some initial stages of capex improvement, but I think this 10 trillion intent by the government, specifically in areas which can have a big multiplier effect, can be a good sort of crowding in factor for the private sector in next year. Remember, next year we will also be hopefully, without any black swan events. Hopefully, I'm saying because you never know when something will hit you. But coming out of pandemic, inflation settling down lower, monetary policy done with what it had to be done. These are all sort of surrounding factors which could actually give us that situation where finally private sector starts getting encouraged by the view forward and starts investing. So I think this, in that sense, combined with government's intent and the large outlay and the background factors, I think it could be a year when we could see a bigger impulse on the capital expenditure.
Okay, now let me play again devil's advocate. I'm also very happy with that number. We went cheering when we heard this number. But Aditi, maybe you're better placed because you look at the state's expenses as well. See, the government itself has trimmed its expense the current years from 7.5 trillion to 7.3 trillion. In this 7.3 trillion, from the start, they've also included the NHAI investments. Some 65,000 crore from last year was already included. And within that, they have set aside 1 trillion for the states. It is giving the impression that the center is also not able to find that many projects and put them out to bid all that quickly. They seem to have a problem. The bandwidth to spend. States have shown that lack of bandwidth even more. What have they spent? 38% of their intentions? You tell me, will they actually spend 10 lakh crore and will the states actually be able to spend what's given to them?
So Latha, the revision downward in the capex numbers for FY23 from 7.5 to 7.3 trillion is basically because the interest-free capex loan to the state governments, the allocation for that has been reduced from 1 lakh crore to about 76,000 crore. And I think 76,000 crore now looks achievable based on what has been approved so far. For a variety of reasons, the pickup of this scheme was quite slow in H1 of last year. And now from the 76,000 crore, which is the revised allocation for this year, for next year, Government of India is stepping it up to 1,30,000 crore. So about a fifth of the incremental capex between FY23 RE and FY24 BE is because of the state scheme. Now, the other 80% is, dominated by things like railways and roads and other sectors where we believe that the government will be able to push through and broadly, we don't doubt that the number is going to be achievable. Fair. But on the state side, we really hope that seeing how large the allocation was this year, now the states will actually build in the 1,30,000 crore into their budgets and this is going to kick off early. And we're not going to have to see another downward revision next year.
Okay. So you're basically confident that it could get spent. Mridul, I wanted to ask you whether all this adds up to a bigger growth number. There are some who are doubting whether 10.5 nominal growth itself is an ambitious assumption, but they've given such a strong capital boost, stimulus. Do you think this can counter the negatives from global headwinds and we may actually be able to propel faster on GDP?
I mean, there's absolutely no doubt that the growth will slow down in the coming period. I mean, a lot has been made out that Euro area may not go into recession, the markets are gumbo. But overall, I think the growth possibilities for the next year are still very, very big. And it will rub on us, but I think this will help counter to the degree that our growth should not fall below 6. I mean, which would be a pretty good thing to do. Coming back to the earlier question about the fiscal consolidation, yes, and that is linked to what Rupee just sort of mentioned. So clearly, the execution of CapEx is lagging behind. So what we need is really a combination that we focus a lot on execution and we focus on downsizing the government. I've been saying this times and again that we need some structural reforms, downsize government, so that we can create fiscal space. And I've been citing the Euro area example where fiscal deficit was actually increased to 6.2 and 6.3 after the global financial crisis, 2 years after the financial crisis. But then they ran primary surpluses from 2015, bringing it down to 0.4%. And they were able to increase it to 7% when pandemic struck in 2020. and they are now back to 3.5 this year, 2022. I mean, this is the activism on the fiscal policy. After all, it's not just the monetary policy that works, but we have fiscal policy also has counter-cyclical effects.
That's true. Well, all that has resulted in about 23% of the total expenditure being interest payments. So, I take your point that in several ways, that kind of discipline has to come. Neeraj, coming back to markets, do you think that the rupee is now well safeguarded because one of the macros, fiscal deficit, seems to be firmly on the downward path? Or do you think the events of the day itself, the way in which we are seeing foreign investors march out, probably because of the attraction of China and the fact that crude is not quite falling, we are still in the 85 handle. Does it mean that come April, we will again worry about the rupee? I mean, we all know that Jan, Feb, March, the rupee is a strong quarter for the rupee. But come April, will we worry?
Yeah, I do worry about the overall level of balance of payment deficit that we are potentially looking at for next year. The headwinds around the capital flows have not yet receded. Clearly, the month of January has shown us the equity flows, again, approximately 40,000 crores worth of equity outflows in the month of January, maybe the second highest in last 12 to 18 months. Does mean that, the reversal in capital flows that we were all hoping to happen hasn't meaningfully happened. We are optimistic on FDI, but how much of that FDI increase can cushion for the FPI flows reduction needs to be seen. Overall, oil prices are still at the higher end of the range. So in a nutshell, BOP situation still looks that it will be in deficit, which basically means that the depreciation pressure on rupee is likely to continue. Okay. Unlike the last year, this year I'm hoping that the depreciation will be milder. The good thing in this entire event scenario is that the Reserve Bank seems to have rebuilt some bit of their reserves again, right? The reserve numbers have actually climbed up, partly maybe because of revaluation, but also partly because of the fact that they have been buying in the market in the past. So that gives them some more ammunition to manage the pace of depreciation. But I am currently looking at some kind of a milder depreciation going forward.
All right. We could have gone on. I wanted to ask you all about rural demand as well, but the finance minister is starting her press conference with the media. So thank you very much, Mridul, Saggar, Aditi Nair, Neeraj, Gambhir, and Soumya. We lost connection with him. But thank you very much for a very enriching discussion.
Dr. T.V. Somanathan, Secretary Economic Affairs, Sri Ajay Seth, Secretary Deepam, Sri Tuhinkant Pandey, Secretary Revenue, Sri Sanjay Malhotra, Secretary Financial Services, Sri Vivek Joshi, Chief Economic Advisor, Sri V. Ananta Nageshwaran. I welcome you all to this press conference. Friends, first the Honorable Minister will give her opening remarks. Thereafter, we'll be taking questions from you. Before I request the Honorable Minister